go. Let me just swap over here. So we're on yours, which is right there. Slideshow. All right, so I'll let you chat about that and go ahead.
Oh, you probably want this is right. Is this a laser pointer too?
Yeah, it is a laser pointer as well. Okay, yeah, cool.
Do I scan that and then you send me Bitcoin automatically?
No, this isn't free Bitcoin, unfortunately. I'm not that rich. I can't give away tons of free Bitcoin for everyone. No, this is a QR code if you want to have the presentation on your phone. I wasn't sure how big the TV would be, and if maybe it's hard to see some of the charts or some of the text, you can scan this and see the whole presentation. All right, so the subject of my talk is my main thesis, which is dollar endgame. Now, who here thinks that the global monetary system is going to run into some serious problems in the next 20 years?
We're already there.
Raise your hands. Okay. Who here thinks they know how it's going to play out? Anyone wants to raise their hands? Okay, nobody. Well, I'm here to tell you that the global monetary collapse won't happen how you think it will. It won't happen how the gold bugs say. It won't happen how Peter Schiff says. And this is all due to some complex interworkings of basically how the global plumbing works within the money system. And this will play into how Bitcoin adoption eventually goes global. So we start on July 1st, 1944. The 44 nations across the world all meet in Bretton Woods, New Hampshire, to start to convene on the future of the global monetary system. Europe is currently in the midst of a major war, and after the war they know that the industrial base is going to be shattered, and they have to figure out a way to basically revive the global economy after Britain and the rest of Europe, emerges from the ashes of this major conflict. In the aftermath of this conflict, in the aftermath of Bretton Woods, gold is set at $35 an ounce pegged to the US dollar, and the rest of the global fiat currencies are all pegged to the dollar. So everyone is basically indirectly pegged to gold, right, through the dollar link. The problem is that there is no method or no structure set up to give the dollars to these European countries. So this bank right here, Midland Bank on Threadneedle Street in the UK, is one of the first banks in the early 1950s to start providing dollar loans and dollar deposits to Europeans, and this starts to create what is called the euro-dollar market. This is actually a picture that my intern took with the Lords of Finance book, if you guys know what that is. But this practice of dollar loans happening abroad began to proliferate in the early 1950s and throughout the 1960s and 1970s. And again, this practice began to spread across Europe and then eventually to Asia and Africa. And these euro dollars are essentially like synthetic dollars. They're creating these, you could call them like naked short dollars that are backed by real dollars in another bank, but these euro dollars are not actual dollars, but they do create dollar demand. So that's very important to note, because this begins to play a major role in how history plays out for the next 30 years. So over the 1960s, you see a huge growth in the European, euro-dollar debt markets. You see here it goes from like 75 billion to 300 billion, well over $1 trillion in today's currency. And over the last, 20, 30, 50 years, the euro-dollar market has exploded to be much larger than the US dollar market. So these estimates, if you can see here, it's 50,000 billion. That means $50 trillion. That's the low-end estimate. The high-end estimate for the euro-dollar market is north of 200 trillion. So all of this creates what is called Triffin's dilemma. This guy, Robert Triffin, goes in front of Congress and presents basically what he sees as a fracturing in the global monetary system. He says, look, we're stuck on Bretton Woods, right? And on Bretton Woods, we're all pegged to gold. So the US has this $35 an ounce hard peg to gold, and we have this problem of external dollar demand. So everyone else needs dollars, and we have to start exporting those dollars and sending dollars abroad to allow them to trade, to allow them to settle debts, to allow them to borrow and to just function as a global economy. The issue arises if the U.S. chooses, what they choose on either side of the equation. So they can choose to fund that dollar debt need outside, so they can either export dollars or not export dollars. If they export dollars, then they start to run into an issue where they're printing too many dollars, then is justified by the reserve ratio, right? But if they don't, then the global economy starts to seize up as the the gears of commerce aren't greased enough by enough liquidity, right? There just isn't enough dollars around to finance global trade. And what he predicted eventually came to pass. By 1971, we saw a break in the gold link to the dollar, obviously on August 15th, 1971, with Nixon breaking that link on a famous television address. And this had been preceded by about like 8 years of straight gold redemptions from major European and Asian countries. The French finance minister and the French then prime minister, Charles de Gaulle, had famously said that the US had enjoyed an exorbitant privilege because they were the only currency with external demand for their debt, right? So they could issue a ton of dollar loans and not really worry about it rising interest rates in the US because they had guaranteed buyers. But these buyers, again, had been drawing the gold reserves out throughout the 1960s, and by 1971, half the US gold reserves were gone. So after we break from the gold standard, the global monetary system enters this kind of like chaotic, like rearranging period, right? The dollar gets significantly weaker. We see massive inflation in the US, the emergence of stagflation, several different oil shocks and geopolitical crises happen throughout the 1970s. And by the end of it, gold has soared to $850 an ounce from the start of 35. And the global monetary authorities, right, mainly the Fed, has said, like, okay, we need to do something to save this system, right? We're no longer linked to gold. Demand for dollars is falling. We need to do something about this. And so they elect Paul Volcker as Fed chairman. And Paul Volcker comes in and he says, okay, so the way to fix this is to hike interest rates in the US so that we strengthen the dollar and draw capital back into US markets so as to not, kind of like continue this trend of de-dollarization and loss of reserve currency that is happening throughout the 1970s. However, this whipsaws too hard, the dollar gets too strong, and by 1985, they have to sign the Plaza Accord, which is a planned devaluation of the dollar between the US and 4 major countries. So the way this process works, again, is what I would call dollar recycling, and this is taken from one of the pieces I wrote. So as these foreign countries grow, they need more dollars in order to hold as forex reserves, in order to settle trade, whatever. And so they start trying to trade with the US and earn US dollars. Now they have a bunch of dollars. They want to earn a yield on those dollar deposits. And so they invest it in treasury bonds, in US equities. And then this bids up the treasury prices, which means that the US gets this cheap funder for their debt. And as this system continues, the US unfortunately has to export their manufacturing base so as to basically allow enough trade to happen globally so that they can export enough dollars to fund the global liquidity crisis that has been developing. And you can see here on this chart from Lynn Alden, right? The petrodollar system begins. Again, eurodollar is probably about right here. And you can see a blowout of the US balance of trade. The easy way to think about this is what's the opposite side of a trade for goods is dollars. It's currency, right? I'm sending you dollars and you're sending me cars. You're sending me oil. You're sending me bubblegum, whatever it is. And so as this occurs, right, as these dollars start to get exported abroad and as dollar debt starts to grow abroad, this creates a massive network effect. We fast forward to today, US dollar reserves are now 62% of total global reserves. It's used in around 80% of interregional commodity trade. Over 55% of global trade invoices are all invoiced in dollars. And basically there's a giant, you could call it flywheel effect that is self-sustaining in the need for dollars and then obviously the demand for dollar-based assets for US equities and US Treasury bonds. And this is where we get to dollar milkshake theory by Brent Johnson. Has anyone heard of this? You want to raise your hand? Okay, a lot of people have. Okay, so to summarize it, and again, you can go back and watch YouTube videos on it if you want. Basically what Brent says is that the global monetary system is like a giant milkshake and the US has the biggest straw. So the US is constantly sucking up more and more liquidity from the global system than the rest of the countries are doing. And this is, again, due to all these factors: the settlement of trade, foreign exchange reserves, lending for international debt and loans, right? There's outright dollarization. You go to El Salvador, you can use dollars to pay for your food. They completely got rid of their own domestic currency. Same with Ecuador. And we also obviously have the Eurodollar market, like we said earlier, this giant kind of hidden shadow banking system where all these banks are lending these synthetic Eurodollars and then demanding real dollars to back those synthetic Eurodollars. And all of this means that all these countries are trading, borrowing in a currency that they cannot print. And so what do? Well, there's a feedback loop that emerges, right? If they don't have enough dollar liquidity, if there's a crisis, right, at home and they need dollars to bail out their currency or to bail out their banks, they have to print their currency to buy dollars on the foreign exchange market. This sends the dollar index higher, this weakens their currency and pulls more capital into the greenback. And then again, as this process continues, this makes actually the dollar liquidity that they needed even harder to get, and the local central banks have to print even more of their local currency in order to get more dollars. And so this kind of like milkshake effect will spike the dollar index occasionally and cause basically like regional currency crises like we saw in the yen and the pound in September of 2022. And the problem is, like, anything you do to stop this just makes the issue worse, right? If you're Japan and you have a bunch of treasury bonds on your balance sheet and you're like, hey, I need to save my currency, and you sell your US treasury bonds in the USD spot market in order to raise cash, what happens? Well, the yields rise, which means that US assets are now more attractive, and suddenly the US dollar gets even stronger and you have to sell even more bonds to raise more cash to intervene in your market and to stop this slow motion train crash. Do people know what country this is? I'm guessing most people do. So this is Japan, and this is one of the countries that's been caught in the effects of the milkshake for the last 30 or so years. Ever since the 90s, Japan's been struggling with a massive debt crisis and a deflationary bubble that has been basically collapsing in on itself, causing the entire economy to grind to a halt. They lowered rates to the zero bound and kept them there for 30 years. Again, it's kind of hard to see, but this is 1997. So if you think rates have been suppressed in Canada or the US, imagine 30 years of this. And as this process has continued, as their economy is zombified and they've done more and more things like QE or QQE or yield curve control to try to fix their deflationary problem, their entire market has basically become zombified. This is a graph of the Nikkei divided by the BOJ balance sheet. As you can see here, it basically flatlines. That means the stock market doesn't go up unless the central bank prints. So you see here some fundamental growth, you see here a little bit of growth, and then just nothing. And why only Japan?
Yeah, why are they the only ones that are...
It's not only Japan. Japan's just like one of the examples. Yeah, it's just one of the examples. But all countries have to deal with the milkshake effect. And again, this opens up this carry trade, which is a key part of the milkshake. You can borrow in Japanese yen at 0%. You can swap that into dollars. You can buy a dollar-based asset like a US Treasury bond. You can earn 5%, and that 5% will be obviously a lot more than the 0.4% that you're paying on the debt that you're borrowing. So it's like an infinite money glitch. And as the Japanese kept interest rates low, that just means that all these companies, all these hedge funds, all these investors just kept going to the banks, borrowing a ton of yen, selling it, buying US dollars and US dollar assets, and the US equity market continued to race higher while Japanese equities and bonds stagnated. And this carry trade really blew out in March of 2022, as you can see here. Once the Fed announced their hiking cycle, this is the USD-JPY currency pair. The higher the index goes, the weaker the yen is. It's a little confusing for some people, but the higher it is, it means that $1 buys more yen, and so that means that the yen is weaker. And this is when the yen devaluation begins. Once the Fed begins their hiking cycle in 2022 and Japan is still stuck at the zero bound, the carry trade becomes literally the infinite money glitch of all infinite money glitches. You can just go and borrow trillions and trillions of yen, buy billions and billions of US dollar assets, and if you hedge both sides of the trade, you're just making free money. And the Japanese have tried to stop this, right? Here's a chart of their interventions in their foreign currency markets. And again, this is where they're running into this effect that we talked about, the intervention doom loop. The more that they try to intervene here, right after one of their BOJ meetings where Governor Ueda spoke, the more the market buoys back up because they sell US Treasury bonds. That drives US yields higher, which makes the US even more attractive on a comparative basis. And here's some tweets from Santiago Capital outlining exactly this process, right? if the Japanese continue down this path, which they have, and they don't really have another option, they're eventually going to send the yen to 200 or 250 to the dollar, maybe 300 to the dollar before all is said and done. And these are some memes I made about the Japanese central bankers and their whole conundrum. They're truly doing the most insane monetary policy, and their monetary policy is kind of like the, I guess, experimental foreground for the rest of us, right? Whatever we see happening in Japan will eventually come to happen in the US and Canada if we continue down the route of, debt growth and financialization and zombification of our markets. And all of this has basically led to a blowout of Japan's net international investment position. So this is how much assets the Japanese own of other countries versus how much other countries own of their assets. So this basically means that Japanese investors don't own any of their own equities or bonds. They own other people's stuff. They own French bonds, they own Canadian bonds, they own US bonds, they own anything but Japanese. That's their whole goal with this process. The problem is when you have all these countries that buy all this US government debt and buy all these US assets, you create a sword of Damocles. I'm sure some of you are familiar with the parable, but basically it's a parable that shows the danger that is inherent in excessive power and excessive hegemony when especially you're unaware of the risk that hegemony will bring. As the U.S. has continued this process of the milkshake, you can see our net international investment position has collapsed to negative 60% of GDP. Right? That's like $19 trillion of US assets that other people own. And again, they're not necessarily owning our assets because they love America or because they love apple pie or whatever. They own it because they have to, because they need dollars, and then they need yield on those dollars. And so if that changes, what are they going to do with their dollar assets? They're not going to hold them, especially if they're not yielding anything in real terms. So here again, it's a chart of the foreign holdings of U.S. Federal debt, and you can see here, in 2008 to 2015, foreigners bought 71% of net new Treasury issuance. So every new dollar that we're borrowing, they're buying 71% of those dollars. Fast forward to 2018 to COVID, they only are buying 14%. So the trend is slowing. And if this continues, they'll eventually buy none of it. And then what happens? The US has to fund all of that ourselves. And that's exactly what happened during COVID. You can see here, Treasury holdings by each major central bank. Federal Reserve spikes massively, right? Because suddenly, now we have to eat our own cooking. We've been making all these Treasury bonds in our kitchen and farming them out to all these other countries saying, hey, you buy the debt, I don't want to have this debt, you guys buy it. And now the rest of the world doesn't want it, especially on the long end. So what are they doing? They're having to print money and buy our own bonds, which obviously creates inflation. And this is what has been pointed out in multiple research papers. Even the BIS admits this, right? They say right here, the most common version of Triffin shifts its thesis from the capital account to the current, right? In doing so, if the U.S. continues this process of doing current account deficits to provide the rest of the world with reserves, it becomes more indebted to foreigners until the risk-free asset ceases to be risk-free. What they're saying there is if the U.S. continues to do this, they will lose reserve currency status eventually. And that will be very detrimental to the United States as well as the world, because this is like a global monetary system that's based on the dollar. And again, I said this in a conversation with Luke Groman, right? If the U.S., if Japan especially, if they have a currency crisis and they're forced to dump dollar assets to raise cash, they're dumping our assets. They're going to cause a massive stock market crash in the U.S., and that would ironically force the U.S. to probably print money again to save our domestic currency bond and equity markets to kind of undo this carry trade effect that's been building up. And this leads us to financial gravity. So I'm sure a lot of you have seen this before. This is the chart of, or this is a graphic created about the Federal Reserve in 1912, 1910, as they were, basically promoting the Federal Reserve Act, and then which was finally passed in 1913. And they understood, right? This is Aldrich. He said, look, if we create a Federal Reserve, if we create a central bank in the U.S., this is going to create a monster that's going to grow in power and influence and size for the next, 30, 40, 50, 100 years. And Wall Street's going to get fat from this monster. And that's exactly what happened. When the Fed was first instated, it wasn't a central bank in the way that we think of it. It was just a lender of last resort to certain banks, and it just in general did not buy government securities or finance government deficits. But as the Depression rolled on in the 1950s, 60s, and 70s, the Fed said, hey, why don't we start managing this business cycle, this process of expansion and recession that's existed for literally thousands of years? Why don't we try to manage it so that there's no gaps, so that we just have this like straight pink line where we're not really booming, but we're not in a recession, so everyone's kind of just chilling, there's no big crisis to worry about. And we'll do that by raising rates into an expansion and lowering rates into a recession, right? And that's exactly what they did. Every time there's a recession, every time there's a crisis, they've been lowering rates. And for the last 40, 50 years, rates have been continually lowered. This is the federal funds effective rate, basically the benchmark rate by which all other interest rates are judged. So this creates this process of financial gravity, right? As the business cycle wears on and as recessions occur and as the Fed lowers rates into a recession, the bad debts aren't allowed to be expunged from the system. No bankruptcies or not enough bankruptcies are happening. So what happens is with each cycle, they lower rates, they pile on more debt, and then there's another boom and they inflate another bubble. They have to create a bigger bubble in order to re-stimulate the economy. And then in the next crisis, they have to print even more money and lower rates even more in order to save the system. And this has led to a blowout of debt in basically every single sector. Here's non-financial corporate debt securities. Here's federal government consumer credit, the student loans. Here's bank credit for all commercial banks. Here's motor vehicle loans. Here's large bank consumer credit card balances. Again, you can see here the fall in 2020, 2021, COVID. And this means, this is a view of the Fed's balance sheet that's been split so you can see assets and liabilities. This means with each crisis, the balance sheet just keeps ballooning. So here's 2008 and then here's 2020. And each crisis requires exponentially more and more money to bail everyone out. Now, what does that mean? What does all this increasing financialization mean? It means that our equity markets have basically become completely dependent on Fed liquidity. For the last 70 or 30 years, 70% of equity gains have happened since 2008 alone. And a vast majority of equity gains, obviously, are isolated in the US, just because of the milkshake effect that we already talked about and all the forces like the carry trade driving money into US markets. This is a chart here of 2021. This is the markets being walked up as the Fed does QE, day after day after day after day. They're just pumping more and more money into the markets, driving equities higher. And again, if we look at this same metric of SPX divided by Fed balance sheet, you can see here, we had fundamental growth in the 1990s, a little bit of growth in 2008, and then just a complete flat line, almost as bad as Japan since 2008. Our markets, again, also are Japanified or financialized to the point where we're dependent on liquidity too. If the Fed decides not to ease, that's bad for markets. If the Fed decides to ease, that's good for markets. And everything is dependent on what the Fed does, not on actually any fundamental realities. And this creates this debt spiral. Again, I'm not going to read through all this, so you can scan it if you want and read it later. But this process of higher and higher debt growth means it's harder and harder for investors to lend to you, which means they charge higher interest, which means you pay more interest expense, which means the debt blows out even harder. And so this process just continually gets worse and worse and worse over time. Now, does anyone have a guess as to what this equation is? Oh, I wish. US debt. Yes, that's the US debt. And as you can see here, it's on an exponential path. And that's not a good thing. Again, if you're the bag holders, if you're the foreigners who own a bunch of US debt, do you want to see that chart? Do you want to see them issuing exponentially more and more debt every single year? Hell no. And this is the M2 money supply. It looks very similar because, again, money is loaned into existence, right? So as the debt number increases, so does the M2 money supply. And it's obviously not perfect, obviously not one-to-one, but the trend is still there. And again, this creates this, paradox, right? If the central bank, like the Fed right now, what they're doing is, they hiked rates and they're kind of keeping them at a high rate. If they do that, they build up more interest expense on the debt, which means they'll actually just eventually have to print more money. And if they lower rates, then they cause more inflation, which makes the deficit blow out, which means more debt, which means they have to print more money. So either way you slice it, the Fed has to print more money. And this is also true of basically every global central bank, right? Not just the US, even though that's the main subject of today's talk. And the terrifying truth is that although a lot of people think that we're just approaching this event horizon of financial gravity, that we're getting close, the real truth is that we're actually already past it. If you look at average interest expense on US debt, we're now over $3 billion per day. That's $1 trillion, right, in interest expense every single year. We're adding $1 trillion to the debt in total every 100 days, and that number is going to get shorter and shorter and shorter in the sense that we're going to be borrowing more and more money every 50 days, every 30 days, every 20 days, every 1 day. And this, again, is an exponential process. It's not good. Here's the US maturity debt wall. You can see here that there's a massive amount of maturities happening in the next few years. Again, we keep interest rates high. This means that a lot of debt's going to get refinanced at high rates, blow out that interest expense even more. And anyone who held these bonds, right, this is the iShares 20-year bond ETF, anyone who held them got absolutely schwacked in the last 2 or 3 years. If you can see here on the far left, it was at like 170, 180 almost, and now it's at 83. So 50% drop in your value of your bonds that you hold. And the Fed knows this, right? The Fed, this is a breakdown of the Fed's balance sheet year over year. Again, this can be really confusing to read. But the important thing to note here is this yellow part at the bottom, which is their securities that mature over 10 years. So this is everything on the long end, right? All the long-term bonds, 10, 20, and 30 years. They haven't sold any of it, even during the taper. And this is from the Fed website, which is the Fed's own database. They haven't been able to sell any of their own debt. If the Fed can't taper debt, how can the Treasury sell that debt? They can't. So they're already running against these issues that are starting to plague the system. And foreigners already know this, right? We already mentioned this. They're stopping their funding of US Treasury bonds on net, and in total, their ownership of Treasury securities is starting to drop. They're not funding our debt. They're not eating our cooking, as we would say. And this creates, again, this kind of like exponential feedback loop, this dollar endgame / milkshake effect, where more and more debt is issued, more and more foreigners don't buy it, more and more of the US Fed or local banks have to buy it, the more and more that debt turns into money because the government spends it on war, entitlements, infrastructure, whatever, and the more inflation that happens, which causes more debt sell-off, right? Nobody wants to own these long bonds. And most people will say, okay, well, again, what you're saying about the dollar is right, but look at Brent Johnson, what he said. There's no alternative to the dollar, right? There's no useful fiat currency that can be used to settle trade. Like the Russian ruble is, from a basically commodity-based currency that's like 70% gas, that's at war. China has a closed capital account. They don't move money in and out of their borders easily. Like none of these countries can compete with the US in terms of either market size or the depth of their capital or debt markets. And I say, yeah, you're right. You're right. No other fiat will compete with the dollar. That's where Bitcoin comes in. Bitcoin has the unique opportunity to serve as a globally neutral reserve asset, meaning that it basically bypasses Triffin's dilemma, the thing we talked about earlier, where you either choose to print a bunch of money to fund the global need for your currency or you don't, and then you have a global economic crisis. Well, Bitcoin's not centrally issued. Triffin's dilemma only applies to centrally issued currencies. Well, we'll get to that. So that is the not dollar, but the Bitcoin endgame. Thank you.